Chris, no one picked 2020 and it was an amazing year. Now you get the chance to tell us what's going to happen in 2021 with the market. Bullish, bearish, where do you sit?
Matt, we typically don't make market calls.
That's not good enough. Come on.
It's not good enough. It's so unpredictable. It was unpredictable last year. In fact, I saw you ask people this question last year, and I bet even if they guessed that the market was going to be up 13% going into Christmas, they wouldn't have guessed what path it was going to take. But having said that, there's a lot of reasons to be bullish about stocks, global stocks this year. We're seeing vaccines for the virus being administered as recently as today. We know that the economies around the world aren't going into massive shutdowns anymore. There's trillions of dollars of fiscal stimulus have been pumped into the economies around the world. Central banks are expanding their balance sheets. They're committed to low interest rates for the foreseeable future. These are all great things for stocks, and the aggravator in chief is out of office starting next year as well. So things are a little bit more benign on that front.
The Donald. Now, as in professional investors, we all love a bit of consensus. What's the consensus trade out there that might just not unfold the way we think?
I think the most commonplace trade, at least over the last few weeks or a couple of months, has been this reopening trade, to tell you the truth. We've been seeing it build. We had early indications that might be there were positive readouts from the vaccine studies, and that led us into some approvals and into the vaccines finally being administered today, and some plans for them to be rolled out around the world next year. And you've seen cyclical stocks that were beaten up earlier in the year bid up a lot, and I mean sectors like brick and mortar retail, travel, leisure. These are all stocks which were beaten down, and some of them are probably going to make it through. There's going to be some, or a lot, that are still going to be susceptible and still have a lot of structural issues. And I'll give you a couple of examples. The cruise operators. So they had to shut down sailing earlier this year. Now, I don't think demand's going to come back to pre-pandemic levels. People just aren't going to cruise the same way they used to. But they've got to take delivery of a whole bunch of new large ships just at the same time that they've borrowed a ton of money and they've got a lot of debt on the balance sheet. And these are stocks that have doubled and tripled and quadrupled.
They're too optimistic out there for those.
Way too optimistic, and in fact, we think that they're actually great shorts for that reason.
All right, professional investors, we get it wrong and we feel sick about it. What made you give you a headache, or at least made you feel a bit bilious over the year?
I wouldn't say it's a headache, but I'd say more of a heartache this year, and the disappointment.
You're in love.
Well, we thought we'd found a real compounder for the decades, and it was Airbus. And this was a business that we'd invested in because it was the leader over Boeing in a global duopoly for commercial jet planes. And the world needed, at that time, about 37,000 more jet planes over the next 2 decades, with a lot of demand coming out of the emerging markets in Asia as they grew up over time. And that was a wonderful outlook for an excellent business, and then the world changed early this year, and it changed dramatically for Airbus, unfortunately.
Bad ending.
It was not good. They had to stall production. They had to take on some borrowings to get through. The demand outlook is just weaker than what it was at the time that we invested, and so you'd say maybe the flight trajectory or the flight path for their earnings is not as rosy as what it once was. It's still an excellent business. It was just caught in the wrong place at the wrong time.
Okay, now let's get on to something you might like to talk about. Get rid of that headache, put on your pajamas, and dream a little about what's a stock that if it was the right price, you'd just back up the truck and fill up.
Dream a little about where we're sleeping tonight, maybe Airbnb. So we would have loved to get some Airbnb at $68 a share, which was its IPO price last week. On the first day of trading, it more than doubled, and it's still sitting around $140 a share. So if that stock traded lower, we'd absolutely love to own that. And it's because Airbnb is a leader in alternative accommodation, and that is a $1 trillion market that's only just getting going.
And they own it.
And they own that space, and it's because they have the leading platform connecting hosts with guests, and they all write reviews, and it encourages them to come back. More hosts begets more guests, and they just keep building, and the flywheel keeps turning there. And it's a wonderful growth profile. It's a very high quality business that just can't be replicated. It's just that price is a little out of our reach at the moment at $140 a share.
Okay, pressure's on. This is what everyone will remember you for. Your stock pick for 2021. What's going to fly?
Well, I'd say what we're most excited about for next year, and for actually many years looking out from here, is the theme or the trend around large alternative asset managers. And the benefit of that is it gives you 3 stocks. So it gives you Blackstone, KKR, and Carlyle. And together, those three firms.
I'm going to squeeze you for one. Which one out of those 3?
Well, Blackstone's the best in class there, but Carlyle's got a lot of upside to its profits. So we're down to 2. But
let you get away.
We like all 3 of them, and together they hold over $1 trillion in client assets. They've been growing those assets under management and their earnings at double-digit rates over the last couple of years. Their clients need them. They need them because they're the only asset managers out there where sovereign wealth funds, pension funds and insurance companies can go to allocate billions of dollars at a time. And they're also trusted advisors, and they have all the systems in place to make it easy for the CIOs at these big funds to sleep at night. Even better than that going into next year is that all of their advantages, all of their growth is going to be accelerated by the low interest rate environment. And I think people appreciate the fact that low interest rates mean higher asset valuations, and that's great for the performance of these funds and performance fees. It means cheaper cost of funding for the deals that they do. But I think most importantly, and what often gets missed, is that low interest rates actually make alternative assets look even more appealing to allocators than their old allocations, and they were big allocations, to bond funds, because they're yielding nothing, and the alternative assets can give these allocators a chance to hit their return targets. And it means that these businesses are going to accelerate with the benefit of low interest rates. And the stock prices are at or around where they were this time last year.